Okay, let's answer some questions from the last market outlook. I didn't do one last week. I'm having work done at the house and there was just way too much noise. Plus I had way too many other things to do. And same with today, I wasn't going to do one. Workers were here all day long trying to get everything done before the end of the month so that I can list the house. So it may be sporadic. As you know from the market outlook, the first 2 weeks of September, I'm out of the country, so there won't be any videos. The first one is asking about seeing your portfolio performance in IB. The best way to do that is on the website itself. Log in to the website. Don't use any of the trading platforms. Don't use Trader Workstation or mobile, the mobile trader. And there's lots on there. Ask me if I will show that at some point in time. Yes, I will. And number 3 is about buying long-term options and rolling them over. When interest rates are high, options are not this. You're not buying at the money that you think you're buying. So let's go out 1 year, and here's the stock price. And let's say that is $45. And if you think, well, if I go out 1 year to $45, I should have a delta equal to 0.5. You won't. The options are centered around the forward price. So the forward price might be $48, and there's where you're going to get the 0.5 delta. So if you were thinking of buying, 0.2 deltas, they'd be even higher. So you do have carry. The stock has to rise by the amount of the carry just to get to 0.5, and then it has to go up just to cover the premium that you paid for. So just keep in mind that because interest rates are high, forward prices are higher. The leaps are easier to buy, I'd say. Not easy in the sense of liquidity, but just easier in terms of what the underlying has to do before you make money. Easier to buy when interest rates are low. Let's see. July was the most active month since 2016 for short covering and hedge funds. And Fitch cut U.S. rating to AA+. As I'm doing this video, the Wednesday, August 2nd, after the market closed, yeah, it sold off today. Had I just held on, for 3 or 4 more days, had I just held on, it would have been a better day to exit today. But you don't know this. Like, you never know. All you can do is what's right in the moment. And after being wrong for so long, for how many points upwards, and it just the euphoria just didn't seem to be abating. At some point, you got to say, I give up. I give up. And I gave up, and maybe it was just a bit too soon. As far as the credit rating, I don't think that's a thing. Other than a dislocation for a week or two on yields, I don't think it's a thing. I bought 25-year bonds today. Bonds maturing in 2048. I bought at a 4.33, I think a 4.331 yield on that, which is not bad considering the 30-year was 4.18 at the time, 4.17. Fairly confident about the bull case for TLT. Also trying to come up with a bear case for risk management. Is there a possibility that capital market rates will increase significantly from current levels? Well, yeah, if you ask for possibility, there is possibility, sure. Probability is the better thing to ask for, but there's possibility. The Treasury also announced issuance, and it was larger than expected, so that is going to dislocate yields at the long end of the curve for a little bit as well. Once the issuance is done, it should revert back. Not too concerned about the effect of further rate hikes, since the short end of the curve mostly reflects monetary policy. Long end influenced by inflation expectations, real GDP. Surprised to see the yield on the 20-year Treasury has been well above 5 for a prolonged time in history. The 20 is an odd tenor. There's not a lot of clientele effect in the 20, and not a lot of issuance in the 20. So it's kind of like just a an odd issuance on the curve. You could sort of just erase the 20 and just think that, after the 10 you got a 30-year. Let's see. The next one is asking about a pairs trade between small cap and large cap based on bankruptcy rates. I wouldn't do it. I get what you're putting forward here. Short the small caps, be long the large caps. That's not a trade I would do. So I don't really have much of a comment on it other than to say it's nothing that I would do. So, the large cap, the mega caps have had a great run. So if there's a pullback, it's more than likely they'll pull back significantly more than small caps, which haven't really participated that much until just a little while ago. So it's a trade that I wouldn't do. So when screening for dividend growth companies, how far back? 5 years? Yeah, I think that's fine. I know you don't personally dive much into the individual bond market. Any advice on key metrics to screen for when looking to buy a bond besides credit rating and OAS? Well, you don't even have to look at the credit rating. The OAS will be in line with the credit rating. And the OAS moves before credit rating changes anyway, so the OAS is the better metric. Any valuable resources before you dive into bond credit analysis? Listen, that's a whole course. In answering questions in the comment section, I don't have the time to answer that question. It would be a couple hours to tell you, here are all the things you need to be aware of. I will say this: if you don't know anything about credit investing, stay away from high yield. If you're bond picking, just stay away from high yield. Grab investment grade. But even then, I don't know that you could do better than just grabbing an ETF that tracks it as opposed to buying the individual bond. The ETF is liquid and has options. The individual bond is illiquid. You need a dealer to get it done. It's just a whole lot of work if you're buying the actual bond itself. Just get exposure through an ETF, and especially with high yield, unless you know what you're doing, don't go picking, because if they default, you're going to be on the wrong side of that trade, and you're not going to know how to deal with the process of default. With your portfolio shifting more towards the bullish side, I'm not bullish. I'm still bearish. Just you can't be short. The name of the game is making money, and I am bearish. I don't think that we belong where we belong, but you got to make money, and being short is a loser, and it has been a loser for me. So you can't be short. All you can do is just not be long. So I am choosing underlyings of which I feel very comfortable holding for multiple years. That if I'm right and the economy tanks in the third and fourth quarter, it never lasts that long, lasts a couple of quarters before we start turning around again. I'd want to be in the names I'm buying anyways. So I'm not bullish. How would you split the weightings of importance between don't fight the Fed and don't fight momentum? Or does it shift back and forth between the two depending on the cycle? I don't understand that part. Depending on the cycle. I'm not sure what cycle we're referring to. Does it shift back and forth? Yeah. But that's short term. Short term meaning that, that was the message today. Was we've gone too far. The mania is ridiculous. Where do we think we're going? We're not going into a high growth regime. Are we crazy? And so there was a sell-off. Tomorrow that may change and say, and by the end of the day tomorrow, you'll wonder, what could possibly take this market down? By the end of today, you were wondering, well, how is this market ever going to get a lift again? Right? And you oscillate between these two kinds of sentiment. I don't know that it's worth a lot flipping your position every couple of days and saying, I'm bullish, no, I'm bearish, no, I'm bullish, no, I'm bearish. How does does the yield on TLT slowly increase as older bonds are sold while new bonds are added at higher yields? Yeah. Yeah. When you were talking about balance sheet runoff, this is saying that it'll bottom out around 6 trillion, then continue to increase at nearly the same rate in the aftermath of the '08 crash. What do you think this forecast reflects? Are they anticipating their reaction to a recession sometime down the road, or maybe they're anticipating a Japan-like demographic shift? I don't know. This Fed is conducting monetary policy in a, quote, ample reserve regime. And the Fed does have a description of what that means on their site, along with a chart or a graph showing the insensitivity of the reserves to changes in rates, which is what they need. That perhaps that size of the balance sheet is what they need now to be in that kind of regime to conduct the monetary policy they want, and maybe they feel they'll continue to do that. That could be it. Other than that, I really don't know. I feel like the market regime of high directionality plus low volatility is really bad for long theta plus macro bet. Effectively, I see asymmetric payoff because you can't collect enough money on your options to offset your downside risks. You better be right with your broad macro view. Is there ever a market regime where you just close up shop and wait for things to make sense? I don't know. If you're waiting for things to make sense, just go into cash. And when I say cash, I don't mean just sitting in cash. I mean sitting in T-bills. Just go sit in T-bills. 5.4 or 5.5% on T-bills. And then just wait. They're very liquid, so you can get out of them. If they're 20 to 30 day T-bills, there's no duration in there at all, and the only rate that will affect a 1 month T-bill is the 1 month rate. No matter what the yield curve does, it can't possibly affect the T-bill because those rates apply to cash flows that are much further out. So the only rate that will matter is the 1 month rate, and that's not going to move unless the Fed moves, right? So you can go sit in cash for a while. Yeah, but if you're looking for a market in which it becomes really easy to do stuff, that's the T-bill market, and it will always be the T-bill market. As soon as you step out into risk, that's why it's called risk. Is you don't know, nobody knows. Nobody knows what the price of something will be tomorrow or in a year. It's all just everybody's best guess as to what you think it's going to be. Whether a price has upward pressure or downward pressure. I think that's about the best that you can do, is determine what direction you think the price will go in. But as far as is this going to go up in price? Nobody knows the answer to that. Nobody knows. In case there's some of you out there that think that there are some large banks that pretty much know what everything is going to do, there aren't. They don't exist. Nobody knows. Because it's the future. And the future is basically unknowable. And your opinion of the future could change the very future that you think is going to happen. So if you think something is going to happen, you may act in a certain way that negates that very thing from happening, at least if it's a widely held belief. Or it may accelerate the thing that would happen that would otherwise not have happened if nobody had the belief. So nothing is inevitably going to happen. So it is, I guess I just don't know how to answer that one other than to say you're describing risk. And that is the arena that we play in, is risk. There's nothing wrong with taking on risk. Taking on risk and crossing your fingers and hoping for the best, that's a terrible strategy. But taking on risk, knowing how to manage that risk, well, then you manage the risk after. You take on the risks that you want, and then you manage that risk. Thank you for closing your short beta position. I think the market, yeah, no kidding, especially today, right? I was the cause of it. Could you expand more on why the Sharpe ratio is not a good measure when assessing a portfolio with options? Is because the denominator of a Sharpe ratio is called a standard deviation. Now, all samples have some deviation within them, but a standard deviation is very particular to a normal distribution. So if we're looking at the return on the portfolio minus the risk-free rate, and then looking at it per unit of risk, this assumes that you have this type of portfolio, but options create this type of thing, right? They give you skew. So you no longer have a standard deviation, right? So your denominator is the wrong denominator, so the Sharpe ratio is not a good measure. My Sharpe ratio in IBKR is very high, around 7. Yeah, that's how you know it's just a ridiculous measure. It's the wrong. You're measuring the wrong. You're using the wrong measurement. I believe the bottom chart, the x-axis, is the size of the company in S&P. Yes, it is. Yes, it is. When I saw this come through, I looked at it again. I said, that makes a lot more sense. Yes, it is. Yes, it is. There was a story on Zero Hedge yesterday about Biden's budget deficits. In 2023, the U.S. is on track to run a deficit of greater than 5% of GDP. Perhaps this extraordinary level of stealth fiscal stimulus is what's boosting the economy and keeping earnings strong. What do you make of this hypothesis? Yeah, it's deficits for as far as the eye can see. Same in Canada. We have a coalition government, a very left-leaning liberal government with an even more left-leaning socialist party, and it is deficit spending as far as the eye can see. I don't know that there is any idea in either the U.S. or the Canadian governments that a balanced budget is anything but laughable. Like why? Why balance the budget and lose votes when we can deficit spend and give money to, interests and parties that will then vote for us? That's, and that's both parties. Both parties do that. But the budget, the fiscal budget now is a campaign tool. So the party in power has the ability to finance most of their campaign promises through the budget. And the taxpayer gets the bill for that. Or should I say the successful taxpayers get the bill for that. If we want to look for a lot of the root causes of inequality in a society, government policies, central bank policies, they do it easily. They're probably more responsible than capitalism and democracy itself. Your remark that potentially markets are moving from fundamental to behavioral. In your view, what tools should we deploy in such circumstances? What tools? I guess if the fundamentals just no longer apply, if you're so far out of the neighborhood where you're looking at the multiple saying, well, look, we can't even begin to talk about the fundamental story here with the multiple. And you have to make up such a magnificent future for the fundamentals to catch up with the price. That sometimes that future is so rosy it could never happen. It is psychology. I don't even know if technicals would really matter. Because you can have overbought conditions. You can have a stock that is well above the 200-day moving average, 3 standard deviations above. You can have a lot of technical signals saying it should pull back. And if there's momentum doesn't care. Momentum doesn't care until it breaks. Once it breaks, then everybody sort of runs for the exit because it's done. So what tools? I don't know. As far as momentum goes, I don't know. I don't know that there might be some technical indicators that suggest that the uptrend is losing steam and waning. But here's the thing: no one knows the future, and the technicals have about a 50% hit rate, the same as flipping a coin. So flip a coin, and you can save yourself years of study of all the charts and diagrams and lines and Fibonacci this and bullshit that, and sacrificing roosters on a Tuesday afternoon if you're wearing a blue shirt if it's an up day. You can get rid of all that nonsense. Flip a coin. You'll be as good as any technical analyst out there. Flip a coin, because that's the hit ratio, right around 50%. And that is not just per indicator. That you take a whole group of indicators, you're still going to have about a 50% hit ratio, because the lines on a chart are after the fact. All this stuff is after the fact. It's all after the fact, but not very useful for predicting what's going to happen next. And honestly, let's think about tomorrow. Are we going to be up or down? Flip a coin. Nobody knows. Nobody really knows. All we can do for ourselves is say, given the levels where we are, am I comfortable buying anything? And that's all we can do for ourselves. I don't know where things are going to go when we're in this kind of territory where the valuation doesn't justify the price, but the price just keeps going up. No matter what the news is, the price just keeps going up. You advised in the past to not outsource your thinking, but it seems you were outsourcing your thinking in Oxy. Could you please elaborate your thought process? Well, I'm relying on somebody else that I already have incredible respect for, and if this person is eagerly buying Oxy, there's something there. Not only that, he's got a history of taking companies out. And he's getting to that age where I think he wants to exit with one really big, incredible deal. So I'll hang out there. In comparing the ROIC and ROCE, my understanding is the numerator of ROCE is NOPAT, whilst the numerator of ROCE is EBIT. What's the difference between the denominators? Well, let's start with the easy one. Capital employed is just that. What is the capital? Debt plus equity. Right, so it's not liabilities plus equity, it's debt. Some liabilities are not interest bearing, so you wouldn't count them. Anything that's interest bearing is debt. So debt plus equity, there's your capital, and then it is just the return on that. Since you're including debt, you want your earnings before interest and taxes, so that you take out the effect of taxes in case there is any tax assets or tax liabilities that are being used. This gives you an idea of how much do the operations of the business return based on the capital that's employed, because you've got that debt and you've got that equity, right? So it's got to be invested in something. If you had all of that just sitting on cash on the balance sheet, well, you'd have a terrible return on capital employed. You'd look at that and say, well, but I can get that in a T-bill. So cash on the balance sheet will have a drag on performance because, well, it'll have a lower return. Whereas return from a company perspective, that's the more important number. Return on invested capital is just that. It's what happens to be invested. If you got a whole bunch of cash, well, it's not being invested in anything, right? So for this one, you would probably take your asset side of the balance sheet, and get rid of the non-interest bearing liabilities again, just like you did with debt plus equity, right? Or another way of thinking about it is the denominator of capital employed is interest bearing liabilities, which is debt plus equity. For return on invested capital, take off your cash, and then on your balance sheet you may have some assets that you'd take off as well, depending on what the assets are. Keep in mind, there is no standard for these ratios. There is no universal standard for any ratio. So you may see it, used in different ways with different adjustments to the debt and equity. Can you please walk us through the chronology of financial products that were created since the 2000s? It's not so much, and I'm not going to do that. That's a lot of research to get that done. That's a lot of research. You could probably get more information from CME for that. What matters more is the moving of a lot of these derivatives off of the dealer books, out of OTC, and into clearing, so that there's third-party clearing for these, and that it's not a whole bunch of counterparty risk, but you have some clearing and maybe even posting of some margin. So that's what I mean by the sophistication. It makes it a more accessible market, and many more products have also been introduced, but a history of them would be a chapter in a book. So I'll leave that to you. Would it be a good idea to look at those to find what in that supposedly new cycle is delaying the end of the cycle? That's... I think it might be interesting for an academic to look at what the effect of different financial products are, or the level of sophistication. And you'd have to measure that level of sophistication across different interest rate hiking regimes. I mean, this is you could call it a dissertation. There's enough there to be a dissertation, probably. Let's see. My question: Will the change in CFA's course next year? Well, when you say next year, I don't know what you mean by next year. Okay, I know that sounds silly, but I don't know what you mean by next year. Right now, it's the 2024. We have 2023, 2 exams left for 2023, and the 2024 content is up. So when you say next year, do you mean the 2025 content, or do you mean the 2024 being next calendar year, you'll be using the 2024 content, or do you mean next CFA content year, which would be 2025? So I don't know what you mean by next year. If you're going to be taking level 1 in 2025, yes, a lot changes. Actually, sorry, that would be level 3, a lot changes. For level 1, I don't know. And even if I did, I couldn't tell you. I can only tell you what CFAI has already said. So for a question like that, I would just refer you to CFAI's site, and if they say something about something changing, then that's what you would go with. If they say nothing, then I can say nothing, even if I know. Question for the Q&A: does it make sense to look at SPY in inflation-adjusted terms? Well, not really, because a price is meaningless, right? If you say, how much is that stock? I say $73. You say, wow, that's expensive. Well, how do you know if it's expensive unless you have some kind of multiple that you're looking at? So it's the multiple that you would look at, and it would not matter if you have about inflation, because it's the price over the earnings, which are both nominal numbers. So if price is going up because inflation is going up, then earnings are going up because inflation is going up. So it's the multiple. The multiple is not is not a nominal number. So you can always compare multiples over time without having to adjust prices for inflation, because you're dividing by 2 nominal numbers to begin with. Another question: do you think it makes sense to adopt a Taleb-like position in the market? Just bleed slowly for a year or two by shorting the market or rolling your puts. When the big moment comes, it will be a home run. Yeah, but 3 strikeouts and you're done, right? Then it moves to the next inning. So, and then again, 3 more strikeouts and you're done. The other team could be scoring a whole bunch of runs on you, so you get 1 home run. Yay, okay, but you're still going to lose the game. I don't like that idea. I don't know why it's called a Taleb-like position. I mean, is that his idea? If it is, it's a stupid idea. So I would say, why? Like, why? If I'm going to bleed slowly for 2 years, or a year or two, I'm going to want to do something else in the meantime. I don't know. I guess I don't know enough about what you mean by a Taleb-like position and bleed slowly. I guess I just don't know enough about what that is to have any other comment than why, you know. Will you be changing your strategies now that taxes won't be a problem? Well, taxes aren't a problem for income generated outside a territorial tax system. So territorial tax system says we will tax all income earned within our territory. So if you get paid from outside the territory, you don't pay tax on it. But there is a concern with territorial tax systems about something called double non-taxation. So typically, passive income, being that it's made outside the country, is not taxed, but it can be taxed to the extent that it has not been taxed, if you get what I'm saying. So the U.S. has withholding taxes. And if the withholding taxes represent roughly about most places 15% tax, so let's say that you should have gotten $1 million in dividends, but because of withholding you only got $850. If it's 15% withholding, then you're good in your territorial tax country. You're good, as long as there was a withholding somewhere, as long as there was at least one tax somewhere on passive investment, then that's fine. But there are ways to turn passive investments into active investments, and there are structures you can use to, sort of not really get around it, but minimize that effect. Overall, it's not going to change any strategy. In the end, it's not going to change any strategy. I've never heard you discuss carry strategies, even though you dabble in currencies. Well, a currency is one form of a carry. There's carry in a whole bunch of things. If you go into futures, there's a whole bunch of carry in futures. If you specifically mean borrowing at a low price and investing at a high price, yeah, I've done that. You can do it. You can open up a spot trade on, let's say, a low yielding currency and a high yielding currency. Go long the high yielding currency, you'll end up with a lot of money, and as long as you put it in short-term T-bills, it's IB considers it cash, it considers it the same thing, so you can take it and invest it in a high yielding asset. Sometimes just holding the cash balance in your account has a payment. I guess that's all I have on that. Could you explain why the fact that the yield in the past 15 years has been a function of central bank activities? Well, because interest rates were zero. Where's the long end of the curve going to go when interest rates are zero? Lead to a positive correlation between bonds and equities. Well, when rates are zero and the central bank says we are not raising rates for a long time, well, bond prices aren't going to drop. In fact, bond prices can continue to increase because there are institutions that must hold bonds no matter what. Central banks in their foreign reserves hold bonds. So the largest foreign reserve out there held by central banks is US dollars, so they hold bonds. You never just hold cash. You'll always hold something that yields a return. It's if you have a central bank sitting on an artificially low rate and also buying bonds, called quantitative easing, that whole yield curve is engineered. So it doesn't really reflect the market. It reflects what the central bank wants it to be. I found balance sheet data as a very important factor. Did you know about the balance sheet number before? Yeah, I report the balance sheet data every week. Something we missed? No, didn't miss it. Think about the fact that the market might just be feeling the full effect of liquidity infusion in the economy, so it takes time for money to reach the bottom of the hierarchy. I don't know how to answer that. That is an assumption that money flows to the top 1% of wealth, and then it trickles all the way down to the bottom. I don't know that money flows to the top 1% and then flows down. I don't know that that's true. I don't think so. I doubt it. No, I don't think it works that way at all. Not one bit. If something broke and the Fed cut rates to 0 tomorrow, what do you think the 25 or 30-year Treasury yield would be? Well, if something broke, lower, much lower, because something broke. Money's going to leave anything that's risky and go to something that's safe, and those are treasuries. So it would be lower. It should trade up around 17.5% to 118 if yields drop to 3% on the long end. Yep. Do you think yields would drop by more than that? You tell me what breaks, and I'll tell you, and I'll give you my best guess as to where it goes. So it is a conditional statement. You know, rates are dropping, conditioned on this thing happening, then I'll have something to say. But something breaking, what broke, right? I'd need to know that first. Share your skepticism that the Fed will lower rates as aggressively as the market is pricing in. As a retail investor, how can I play this? I can't short 2-year bonds, but want to exploit a higher for longer position by playing rates somehow. Then buy T-bills, 5.5%. There you go. Just buy T-bills. What are your thoughts on entering the bull market or bull call ratio back spreads, right? Potential momentum rally with having backside protection in case something breaks. Yeah. I mean, I don't know how much more to say on that other than, yeah, it's a strategy. A more technical question, how would you hedge a callback ratio mid-trade? Well, theoretically, you tell me what you have and what happened, and then I can answer it. I say that a lot, you know, like whenever I'm asked about some future event and what would you do, you tell me what happened, and I'll tell you what I would do. But just to say this is what I would do means there's a rule. And if there is a rule, then it can be programmed in, and algorithms would do it, and humans wouldn't be involved, and there would be no trade because it would purely be algorithmically done to the point where you couldn't even get in the trade. You tell me what's going on, and I'll tell you what I would do. And that's about the best that I can say. Is it too late to get into the options course? No, it's just streaming. It's they're already done in online streaming. Crude oil just experienced its biggest weekly drop, much below expectations. It was a big drop, yes. Would this theoretically imply a bullish signal for oil prices and just energy inflation may rise again? Well, it's bullish for oil, let's just say that. I mean, it's certainly not bearish. Maybe it's not bullish, but it's certainly not bearish. It could be bullish if the market is willing to accept it as bullish. Unless you're having sell-off days like we had today, then no, it probably just did not matter. And when I looked at the oil companies from Canada to Mexico to US, yeah, they were all red. All of them were red. It didn't matter. So, you know, the weakness in energy stocks was probably more of an effect of the market itself rather than oil. Suggest energy inflation may rise again? No, I don't. I don't think so. No. I don't know that on its own is enough for me to say, yeah, here we go. I mean, it's energy, it's crude oil in the U.S. So no. There's been an alleged advance in the superconductivity field that, if it tests out, will make all the AI stuff look like a flash in the pan. Fortunately, the target material is easy enough to make in any major university lab that by September it should have dozens of replications or show to be BS. It bears watching, but it wouldn't start throwing money around yet. Well, how could you? You didn't say anything about anything. There's an advance in this field. If it works, it'll be great. If not, it won't. Don't spend money on this thing that I'm not telling you about. A little bit more specific first, and then we can talk about not throwing money around. I don't know what it would be. 2 questions. Your comment on them potentially selling MBS. What impact would or have on table securities? I've not heard that expression before. I don't know what a table security is, whether it's an asset. Okay, so I can't answer that. You're closing your short position. Does that change your view on TLT? Nope. Based on no TLT change that you mentioned, your comment 60-40. I imagine it doesn't change your thesis on it. That being said, I'm curious to hear if now you think rates will continue to climb so that TLT could face further downward pressure in 2024. From what I'm seeing now with price pressures coming down, and not just in the U.S. but in other countries as well, no, I'm having a hard time seeing that a lot more rate hikes are ahead. I don't think rate cuts are ahead. I don't think, until it's very clear that we're back at the target, which, it seems that we're heading there. So, no, I don't know that there's a lot of upside left in money market rates. Now, capital market, that's a different thing altogether. That's views of inflation expectation and GDP. But if you have a lowered expectation of growth going forward and lowered inflation expectation, the market will accept lower yields. To get higher yields, you would have to have significantly higher GDP growth or significantly higher inflation expectations, which would lead to higher rates, which would lead to lower GDP growth to offset those higher inflation expectations. So I don't think that would be the pathway to higher yields. I think the pathway to higher yields would be inflation slowly moving to 2%, but growth just accelerating. And I mean going from an expectation of 3% to 3.5% to 4% to 4.5% to 5% real GDP, like just an explosion of growth. Yeah, I think you'd probably get something moving up on the longer end of the curve. I don't see that either. That's for my comment. It's a comment, so we'll pass on the comment. Other people can read the comment. Let's see. Describe the difference generally between operate. Oh, somebody already replied to that, and they were correct. I think most people in the market right now are buying based on the bottom-up approach. Maybe. In terms, it seems that monetary means are less effective now. What are some fiscal-driven actions the government could do to control inflation? Stop spending money. They're not going to do that. Allow immigration, allow higher levels of immigration so that you can put slack into the labor market and increase unemployment without people losing their jobs. Just newer people coming in don't have them. They're not going to do that. Don't look to your government for the solution to any difficult problem. Look at them as the source of problems, but do not look to them as for any kind of solution to a difficult problem. If you want solutions to difficult problems, you have your central bank, you have your Treasury, potentially, and you have business. Business is if you're looking for the tone and the change in society, business is by far the leader. Politicians simply follow along. But politicians really aren't the solution to anything, and government really isn't really an effective solution to any difficult problem anymore. So I wouldn't even think about the fiscal, because whatever solution it is, they're not going to do it. It's not going to happen. Wondering about retirees' level of spending being more inelastic to the business cycle. If we consider only wages, this would be true. But considering that their wealth has decreased substantially in the past 2 years, well, we don't know that it has decreased substantially in the last 2 years. We don't know that. Since, you got the vast majority of them, 50%, if not more, of their retirement value is sitting in their home. And perhaps, when we're talking about quite a few people still have access to defined benefit pension plans. So that's not their problem. Almost every government employee, almost every university employee that's retiring, almost every middle-level manager and higher that's retiring has had defined benefit pension plans, so they're good. The value of homes are, looking at Case-Shiller on a worst-case scenario, 1.7% below where they were last year. 1.7% below, and in some cases, housing prices are higher than they were before they turned down last year. So housing prices have held their value quite well. The market, well, up until the end of last week, was sitting 5% below all-time highs. So we don't know that their wealth has, as you say, decreased substantially. We don't know that. Would this affirmation about their spending being uncorrelated with the business cycle still be true? Yeah, I think it would be. So let's say that I'm holding bonds, $3 million in bonds, and now they're only worth $2.4 million in bonds. I don't have to sell my bonds. The yield on them is enough, and as they mature, if I have a good laddered bond portfolio, as they mature, I'm buying bonds at a lower price with a higher yield, and at some point rates will go down and bring my bond portfolio back to that $3 million. They're not like equities where maybe equities will go back up when things get better. Bonds will. And if you hold a bond, no matter what loss you think you have, you're going to get par. You're always going to get par. So if I buy a bond today for 93, let's say I buy a 7-year for 93 or a 10-year for 93. I don't know. Just make up a bond and make up a number. And rates rise and the value of that bond falls to 86. Well, that's 86 if I want to sell it today. I don't have to. I can say, look, I'm holding it for the interest income. That's fine with me. And I will get par. I'll just continue to hold it. And as each day passes, that bond will be pulled to par. Interest rates will mess around with it only to a certain point. But as it gets younger and younger, it gets pulled to par. And if I'm retiring, I certainly don't have a portfolio of 30-year bonds. I've got a laddered portfolio. And I still have an equity position more than likely, unless, I can't afford it, in which case, that's not really an important thing. The generation retiring now has probably the most wealth of any generation. And that wealth is probably being passed on as they die, being passed on to the next generation. And when you inherit something, you are price insensitive because you didn't earn it. So I think we have some problems here with saying decrease substantially. We don't know that that's true. And if they are in bonds and they have taken a hit, they will always get par if they have a laddered portfolio, which their advisor most likely would have put them in one. They'll be fine. Or they have defined benefit, and it's not their problem. It's the sponsor's problem, right? Why would the expected productivity gains be positive? I don't know that they will be positive. The economy is good, jobs are plentiful, and households haven't felt the crunch yet. Why would people suddenly start? Well, that's not really what productivity is. It's not just that you're just working harder. It's that you're working more productive. So it just could be that waste is eliminated, right? So let's say that you have a workforce of 10,000 people. and you cut the bottom 10%, you cut 1,000 people, you send the message through to all your supervisors, say, look, we need to get rid of the unproductive people. And in every department, there's always one. If you work in an organization, if you work in a company, there's somebody in your department or in the cubicle beside you or around you where you think, they never do anything. Like, they never do anything. They're always in right at 9 o'clock. They always leave right at 5 o'clock. They're a clock watcher. They smoke 7-8 times a day. They're in the bathroom 4 or 5 times a day. They're so lazy. You can't count everybody in an organization knows someone like that. Well, if you just get rid of those people, then they're done. There is some aggregate numbers that lean towards statements like that about 50% of the work in an organization is usually done by 10% of the people. So there are a lot of people in an organization that you could probably do without. That in good times you think, what's the point? But in if you need to increase your productivity, in other words, decrease your unit costs, every organization has at least, no matter how small they are, let's take a company with 25 employees, there's always at least one person that most people can agree that if you get rid of that person, nothing would change. Nothing would change because they never do anything anyways, and when they do something, you got to go in and redo it again anyway. So you can increase productivity by just getting rid of those people. So it doesn't mean that you're working harder, just if companies send the bottom 10% out the door, you get a boost to productivity right away because those 10% probably weren't contributing much to begin with. What resources would you recommend to someone looking to learn about the capital markets? CFA, period. The CFA program. That's what I would recommend. Any thoughts on the latest GDP now? Yeah, 3.9. Crazy, 3.9. Growth is looking surprisingly strong with government spending and inventories in particular. Yeah, that is true. Anyone have a link to the forecast charts and interest rate coverage ratios? I got those out of a story online. I didn't get them from the source. It was part of a larger story, and it was exhibits within the story. I skipped last week's Q&A. I did. I'd like to speak to your manager. Let's see. Karen? No, it's not Karen. Acknowledge your analogy regarding coevolution and rates. My argument against it would be that given such low rates in the decade leading up to COVID, has there even been a need to evolve against interest rates? Second question is it possible to measure the level of interest rate sterilization in the economy given it would be mostly OTC? A lot of it, yeah. A lot of it OTC, but think about 30-year fixed rate mortgages, right? And interest rates go up. The homeowner is immune from those interest rate hikes. So the mortgage payment on their debt, they could just walk around saying doesn't affect me. I got a 3% mortgage, doesn't affect me. This leads me to the question, who's on the other side of these contracts and how are they doing? Usually it's a dealer who hedges out. And you have to understand when we say that that when you're immune from interest rates, you could be immune from interest rates on a liability side, and somebody needs to be immune from interest rates on an asset side. Well, now you have a marriage, right? Now they can both benefit by being on opposite sides of a contract. So there are all sorts of reasons why you would be, converting an asset stream into a fixed or floating, or a liability stream into a fixed or floating, and the dealer sits in the middle, will offset as many of those as he possibly can, or she possibly can. The dealer is the counterparty to all of these. Well, actually, they're interest rate swaps, so there is now a third counterparty that's counterparty to every swap. But think about a corn farmer and a cattle rancher. The rancher needs corn. The farmer needs to sell corn. Both of them have risk. The farmer agrees to sell forward the entire crop to the cattle rancher. The farmer knows what price he's going to get. The rancher knows what price he's going to pay. So corn starts fluctuating wildly in price. Both of them sleep well at night. Both of them are immune from the price changes in corn at that point in time. Now, you could argue that, yeah, but one of them could have done better. That's the point of getting immune, is that you say, I don't want to be affected by it either way. So you do take that risk that, well, it could have helped you. Yeah, but it could have hurt me, right? So for everyone who wants to protect a liability stream of cash flows, there's somebody who wants to protect an asset stream of cash flows or an asset value. If you're worried about the value of your liabilities going up because rates are dropping, somebody else somewhere else is concerned about the cash flow from their assets dropping because rates are dropping. And just reverse it. There are two sides to the balance sheet, so you can always find a marriage. What happens when everyone that holds swaps futures needs to roll over? Well, then that's where interest rates catch up with them. Once you need to roll over, then yeah, you're rolling over at the newer rates. Every other investor I know bought a house to rent out in the last few years. Not to mention vultures like Invitation Homes. They are not keeping a hold of these homes to preserve their low rates. They are doing so because of the cash flow. The moment that stops, it will run for the exit. Since ABR has been up so much, are you doing any option strategy to your position? Nope. No, I never do. Well, I shouldn't say I never do. I don't sell the upside on them. I'm more than willing to sell puts on them. More than willing. I would love to see, ABR has pulled back from its highs last week down to the low 16s. I'd love to see a good washout in the market and ABR hits 10 or $9. I would load up on that little fella. It has been my friend for quite some time. With your level of wealth, this is an interesting question, okay? With your level of wealth, instead of continuing to shoot for a high score in wealth by looking at tax-advantaged countries, maybe it's time to start trying to maximize happiness for end of life where you'll move to. Who says I'm not happy? And happiness is the wrong thing to pursue. Happiness is fleeting, and happiness is expensive, and you got to chase happiness down. It is the wrong thing to pursue. And who says I'm not happy? Right? Can I not do both things? Can I not walk and chew gum at the same time? I think I can. Many news articles point to Europe countries as having the happiest populations. Well, that is a statistic, a macro level statistic. That does not mean everyone in those countries is happy. There is a distribution of happiness in every country. They may score higher on certain measures of happiness, and certain countries do, but I want you to look very, very closely at the countries that do. They are very homogeneous in their population, and they have a very low level of inequality in terms of wealth. You need those two things together. You need a homogeneous population, and you need a low differential between the upper 10% and the lower 10%. You cannot just have one or the other. You need both. So they score the happiest because they all feel they're in it together, that they're sacrificing for people that are like them. They have very homogeneous populations. Or you would say in today's language, they have the least diversified populations. This is the problem with diversity, and politicians saying diversity is our strength. At the level of a group, diversity of opinion, diversity of belief, diversity of skill is an absolute strength. At the level of a country, diversity is a weakness. Diversity taken too far is a weakness, not a strength. If it was a strength, you would never have to say it. You'd never have to say it. It would go without saying, but that you have to say it is an issue, right? Although many have high tax rates and high cap gains rates, they may offer you a higher level of happiness via lifestyle. I got a happy life. I got a great lifestyle. I can't even tell you how great my lifestyle is. I sound like Donald Trump there. Listen to me, folks. You're not going to believe it, but I got a great lifestyle. I can't even tell you how great it is, folks. Listen, happiness is the wrong thing to pursue. Okay, whoever told you that you should be pursuing happiness has it wrong. And even I think the Constitution, was it the Bill of Rights, life, liberty, and the pursuit of happiness? It's not the pursuit of happiness that means anything. Happiness is a byproduct, not something you chase. Look for meaning in your life. When you look for meaning in your life, you'll generally be happy. And I got a lot of meaning in my life. I'm happy. But that doesn't mean that I have to take an unfair tax system and say, oh, okay, I'm happy. I'm not going to a tax advantaged country to find happiness. That would be a hollow, shallow thing to do. I am generally quite happy. I have meaning in my life, which means I am fulfilled. I'm not happy every minute of the day, but overall, if I had to rank things, if it all ended tomorrow, I would say, I had a good run. I had a good run. So, also, have you considered buying a suite on a cruise ship and living on it full time? I know there are these ones that go all the way around the world. Like they'll go to like 150 ports, but there's a whole bunch of risk associated with those. And living on a ship is not what you think it is. You don't have a suite. It's not like the Queen Elizabeth II where you got a 800 square foot suite on a ship. You got a bunk. You got a little bunk in those. No, I don't know that I would enjoy that. One pushback I have regarding the comment about okay, I already answered this. This is about who's on the other side. If someone would like to earn his or her domestic risk-free rate in the case where it is complicated, expensive, or not even possible to access money market securities, would it make sense to buy US T-bills and FX futures contracts to hedge the currency? And if it's not possible for you to access the domestic money market security, I doubt that there's going to be a futures contract for your currency. Unless it's just a cash settled, which you may or may not be able to trade in your country. So, if it's that difficult to access, something like this might be just as difficult to access. What is your opinion with industrials as an asset class over the next super cycle? They are cyclical. I don't know. I haven't really thought about it too much as a sector. Individual stocks maybe, but as a sector, I don't know. I guess I don't have a strong opinion either way on that one. What made you choose Costa Rica? Do they not have a 25% tax rate? Nope. Well, maybe they do. They have a territorial tax rate, which means that any income earned on the territory, within the territory, they tax. But if you earn your income outside of Costa Rica, then they don't tax it. Are there not many options that have 0 to 5? Yeah, there's I think 12 countries in the world that have territorial tax systems. And then there's the digital nomad, but God, you're living out of a suitcase for, a year or 2 years at a time, because if you get any possessions wherever you happen to be, well, you have to leave that country at some point. That stuff doesn't move very well. So you're basically living light for a period of time. Interested to hear more of your thoughts around socialism, Marxism, and your thoughts on if other Canadians are feeling the same as you and looking to become expats. Well, I don't know anybody who likes a 53.5% tax. I don't know anybody who wants to take the chance on our coalition government, our left-leaning Liberal and Socialist Party government, our two prime ministers, are at some point are going to have to pay the bills, and they're going to raise taxes, and they're not going to lower it on the bottom 70%. They're not going to raise. They're not going to raise them on the bottom 70. They're not going to raise them on the middle class. They will go after successful people, because successful people are too small of a class to change the outcome of any election. So they'll go after successful people. So I'm out of here. I'm sure you were not so happy to see the credit rating downgrade. Didn't bother me. I understand GDP is an important figure to keep track of. However, I do not understand why the market would react in any significant way, much less the way it did from the release, because it came in stronger than expected, noting that real GDP growth in 2007 was higher. Well, you can't compare things like that. You can't just say, hey, in 2007 a GDP report was higher and the market did this. Now it was lower and the market did the same thing. Well, you can't compare them like that. Why did the financial news media and market make it seem like the economy is strong? Because the expectation was for something so much lower. The surprise is the number was much stronger than anybody anticipated. That was the big surprise. How does the Fed having a large balance sheet means there's a lot of liquidity in the system? Well, if they're holding a security, that means somebody else is not holding it. So what are they doing with their cash? It has to go somewhere else. So it has to buy something else. So if the Fed bought $10 trillion worth of treasuries, well then other investors with $10 trillion to buy treasuries would be shit out of luck. It'd be like, sorry, you got to go somewhere else. This club is full. They'd have to go buy something somewhere else, and that would push the price of something else up. Not to be rude, but now that you and Mike Wilson have capitulated, I will add to my short. And you did very well if you added to your short. I should be an indicator. Let's see. How can we monitor the overall debt bankruptcy situation? If you have a good data feed, there's probably information there. Bloomberg probably has a lot of good information. Is soft landing achieved? Too soon to tell. Hard landing, we know. What is the finish line for soft landing? No finish line, just low growth for a while, followed by expansion, I guess. Where's the next question here? From what I gather in your weekly updates, you're leaving Canada mostly because of taxes. Mostly because of taxes, but I've been here, well, and I've lived in the U.S., but I've been pretty much Western, North American culture my whole life, and I've done quite well, and I want to see the world. And I keep thinking, when I'm finished this thing that I'm working on, and then when I get to this point, and it's always a couple of years down the road, oh yeah, I'll start doing this at this point. Well, why not now? Why not now? So I picked one location, and I could see 2 to 3 years there, and then it'll be time to go to the next location. I don't know what it'll be, but I'm certainly not moving somewhere and that's it. It'll be 2 to 3 years, and experience something different. Take me out of my comfort zone and see this big, beautiful world. There are, I think, two things in your in life. You have one or the other. Either you have a lot of family and relationships, and this is your thing, that you don't need to see the whole world. You have that, and that's going to be important for you later on. I don't have any of that. I have no family. I'm not attached to anyone. I have no ex-wives. I have no kids. I have nothing holding me here. So at that point, relationships aren't important to me because they don't exist in my life. So I may as well do the other part of it, which is see humanity, see the rest of the world and what it has to offer, and So that's the other half of it. Is I'm not going to be a horse on this animal farm in Canada, and let's see the world at the same time. As a 30-year-old in Hong Kong looking to leave the city, Canada opened up her doors to us. Her doors. Are you assigning a gender? Are you potentially misgenderizing our country? Wait till I tell the Liberals. Oh man, they're going to take to Twitter and rip you a new one. You are potentially misgenderizing our country. What major downside do you see for people moving into Canada? I don't really see a downside. It's not a bad country overall. It is, I think, not a friendly country if you're successful. because you are expected to shoulder a lot more of the responsibility of the finances of the country than what would be, I'd say, fair share. If we had a 40% tax rate as an upper tax rate, I would not be thinking of moving. But we got a 53.5% tax rate. Well, that's a 40% tax rate and a 13.5% confiscation rate. Now, you're taking 53.5% of my income and saying, okay, the rest is yours to spend, but we have a 13% sales tax as well, right? But let's say I want to go buy a $250,000 car. You would think that after getting hit with 53.5% and after 13%, geez, that's enough, right? Well, in Canada, anything over 100,000 has a luxury tax. You pay another 20% tax. So have a consumption tax for luxury items, or have a high income tax, but don't have both, because now you're just punishing us every single way you possibly can. You do very well, we're going to punish you. Oh, and if you want to enjoy the fruits of your labor with whatever you have left, we're going to punish you again. And then you have Prime Minister Singh. We have two prime ministers in Canada, one that was elected, one that really holds the power, which is Jagmeet Singh. Trudeau can't do what he wants unless Jagmeet agrees. He wants to implement a wealth tax, which means that we're going to tax you at 53.5%, and next year we'll come back, we'll take another 2. Next year we'll come back, we'll take another 2. Next year we'll come back, we'll take another 2. So over the next 20 years, you're going to take 40% on top of the 53%, you're 93.5% tax, and if I try to spend the 6.5 cents I have left, I got to pay 13% sales tax on it. Give me a break. You know, you can't make me responsible for everybody's failure. At some point, enough is enough. So, yeah, I'm getting out of here before the wealth tax comes in. Yeah, so just, you know, Canada's a great place, but just try not to be too successful. If you're just successful enough, you'll be okay. If you're too successful, well, then you will be punished. You will be punished. Let's see. Can you show us how you get the values for C, I, G, X, and M? Yeah, Table 2. Just get the GDP report from the BEA, Bureau of Economic Analysis, and it is Table 2. Gives you the contribution of each section to the, it was 2.4%. It gives you the contribution of that 2% for each of the components. And there we go.